Many investors have the urge to regularly check how their stocks are doing. Studies have shown that over the long term this can be detrimental to building wealth. When you hear good or bad news about stocks or the economy, do you get the urge to check how your investments are doing? If so, you're not alone. In fact, recent research has revealed that half of investors check their portfolio's performance once a day or more. While keeping an eye on your investments is obviously sensible, checking them too often can actually hurt your performance. That's because the more often you look at your stocks, the more likely you are to see a loss. Let me explain. On average, the stock market in the US is up daily about 53% of the time, weekly about 60% of the time, yearly about 67% of the time, over periods of 5 years 87% of the time, and over periods of 10 years 94% of the time. Do you see a pattern? If you check the market every day, you have an almost even chance of seeing a loss. However, if you only check your portfolio once a year, you are statistically much less likely to see that your stocks have gone down in value. This is important because seeing losses has an outsized effect on our decision making. In 1979, two economists, Daniel Kahneman and Amos Tversky, discovered that the way our brains process negative emotions, such as fear and regret, tend to be more powerful than positive emotions, such as joy and satisfaction. Kahneman and Tversky coined the term loss aversion to describe this phenomenon. One of the most famous experiments on loss aversion was conducted by Kahneman and Tversky in 1979. In the experiment, participants were presented with two choices. Option A was a 50% chance of winning $250 and a 50% chance of winning nothing. And option B was a 100% chance of winning $100. Most participants, around 84%, chose option B, which was the risk-free option. And this result was consistent with the idea that people are generally risk-averse. Next, Kahneman and Tversky then presented the participants with two different choices. Option A, a 50% chance of losing $250 and a 50% chance of losing nothing. And option B, a 100% chance of losing $100. This time, most participants, 69%, chose option A, which was the riskier option. This result was surprising as it suggested that people were more willing to take risks to avoid losses than to make gains. This experiment has been replicated many times and the results have been consistent. It's now well established that people are more sensitive to losses than to gains. Loss aversion can lead investors to make poor investment decisions. For example, we might avoid adding to our 401k account because we fear a market crash, or we might avoid investing altogether and keep our money sitting in a bank earning no interest because we are so risk averse. As shown by Kahneman and Tversky, loss aversion can paradoxically push some into risky investments like crypto because they fear missing out on big gains. These behaviors can all result in lower investment returns over the long term. By checking your stocks daily, you are increasing the possibility that loss aversion will cause you to do something that you will later regret. Professional traders often have a support team of other traders or mentors who they can talk to about their trading and get advice from. They also have a disciplined trading plan and must use a variety of risk management techniques such as stop loss orders and position sizing to limit their losses on each trade. Regular investors have none of these things, which makes them much more susceptible to making unwise decisions. In conclusion, by limiting the number of times you check your accounts, you will be much more likely to see your net worth grow. By contrast, if you spend all your free time checking your stocks, you will statistically see more losses, and this may cause you to do something that you later wish you hadn't.